Welcome to the deep dive. Today we're tackling something really fundamental for Canadians, the RRSP, the Registered Retirement Savings Plan.
Yep. And we're specifically talking to you if you're starting from scratch, like zero knowledge.
Exactly. If retirement planning feels like this big, confusing cloud of jargon, well, you're in the right place. We've gone through a ton of beginner guides.
And we've boiled it down.
Yeah.
The goal here is to cut through that confusion, give you the core mechanics, the benefits, and, the pitfalls you really need to watch out for.
So our mission today, get you comfortable with the RRSP basics.
Right. Because honestly, the biggest hurdle for a lot of people is just feeling overwhelmed. That feeling leads to doing nothing. And doing nothing is really costly when it comes to retirement savings.
So true. Decades can slip by.
Yeah. So we're focusing on the key stuff, how it saves you tax now, and how it helps your money grow for the long haul without taxes hitting it every year. Actionable knowledge, that's the aim.
Okay, let's just jump right in then before we get into all the rules. What is an RRSP? Like the absolute basic level.
Think of it like a special savings account. But one, the government gives special treatment to encourage retirement saving.
Special how?
Two main ways, really powerful ways. First, when you put money in, you usually get a tax deduction for that amount, right off your income for the year.
Okay, so less tax today, that's benefit one.
Exactly. Benefit two is maybe even bigger long term. While your money is inside the RRSP invested and hopefully growing, you don't pay any tax on that growth.
No tax on interest, dividends, capital gains.
Nope, not year after year anyway. It all just grows. Tax-deferred is the term. You only pay tax way down the road when you take the money out in retirement.
Okay, so the idea is get the tax break now when you're earning more and probably in a higher tax bracket.
Right.
And then pay the tax later in retirement when your income and hopefully your tax rate is lower.
You got it. That's the fundamental strategy, tax timing.
Makes sense.
And look, since the whole point here is getting you from knowing nothing to maybe taking the first step, we should mention if you listen to all this and think, okay, I need some actual help putting this into practice.
Yeah.
Well, the resources we looked at often point towards checking out Muneris.com. Muneris.com. Seems like a good place for practical guidance based on this stuff.
Good to know, Muneris.com. Okay, so framework established. Let's build on that. Who can actually open one of these accounts?
Yeah.
All right, eligibility, is it for everyone in Canada? Any catches?
It's pretty broad, actually. But there are a few key things. You need to be a Canadian resident, obviously.
Okay.
You have to be under 71 as a hard stop, age-wise, we'll talk about.
Under 71, got it.
And crucially, you need to have what the government calls earned income in Canada. And you need to file a tax return.
Okay, earned income. That sounds specific. We'll need to define that. But let's stick with age for a second. Under 71, when can you start? Is there a minimum age?
Well, there's no official minimum age per se. It's really tied to having that earned income and filing a tax return. As soon as you do that, you start building up contribution room.
Even as a teenager?
Absolutely. If you have a summer job, maybe deliver papers, whatever, if you earn income and file a tax return, you technically start generating RRSP room.
Wow. So a kid could technically open an RRSP.
If they ever earn income and file taxes, yes. It's rare, maybe, but possible. And imagine the head start. Decades of compounding.
Incredible. Okay, and the finish line. You said under 71. What happens then?
Right. December 31st of the year you turn 71. That's the deadline. Your RRSP must be closed or converted into something else, usually a RRIF, a Registered Retirement Income Fund. It's a mandatory transition.
Okay, we'll definitely come back to that conversion. Now, let's tackle the big why. Why go through the RRSP hassle instead of just, a regular savings or investment account?
The million-dollar question. It really boils down to taxes, specifically how investment growth is taxed.
Oh.
In a regular, non-registered account, just a standard investment account, any income your investments generate, like interest or dividends, gets taxed that year. Same with capital gains when you sell something for a profit.
So the tax man takes a bite every single year.
Exactly. And that bite slows down your growth, right? Because the money paid in tax isn't there anymore to earn more money next year. It dampens the compounding effect.
Okay.
Now, inside the RRSP, all that growth, interest, dividends, capital gains, it just accumulates. No tax bill each year. It's sheltered, deferred.
So the full amount keeps working for you year after year.
Precisely. Plus, remember, the money you put in was tax deductible. You use pre-tax dollars. Money in a regular account, That's after-tax money you're investing.
Right, big difference.
Huge difference over decades. That uninterrupted tax-sheltered compounding is where the real magic happens for long-term wealth building.
Okay, I'm convinced. If someone listening is thinking, all right, I need one, where do they actually go? And is it complicated to set up?
No, it's actually super easy these days. Not complicated at all. You can open an RRSP at pretty much any financial institution.
Like the big banks?
Yep. Banks, credit unions, trust companies, insurance companies, and increasingly popular online brokerages.
Online brokerages for like a self-directed RRSP.
Exactly. A self-directed RRSP means you choose the specific investments inside the account. Stocks, bonds, ETFs, whatever. It gives you the most control, but also requires the most know-how.
Makes sense. What documents do you typically need to get started?
Pretty basic stuff. You'll definitely need your social insurance number, your SIN,
Okay.
some government-issued ID like a driver's license or passport.
Standard.
And it's really helpful to have your latest notice of assessment from the Canada Revenue Agency, the CRA.
Why the notice of assessment?
Because that document tells you your exact RRSP deduction limit for the year, your official contribution room. Super important number. We'll get into why later.
Got it. So, SIN, ID, notice of assessment, not too bad. Now, are all RSPs the same, or are there different types?
Good question. There are a few main types you should know about. The most common is just the individual RRSP. It's in your name for your retirement. Simple.
Standard.
Then there's the spousal RRSP. This one's a bit more strategic.
How does that work?
Okay, let's say you have a couple where one person earns significantly more than the other. The higher income spouse can contribute to an RRSP, but the account is actually registered in the lower income spouse's name.
Huh. So the high earner puts the money in, gets the tax deduction, but the account belongs to the lower earner.
Exactly. The contributor gets the immediate tax break based on their higher income. But when the money is eventually withdrawn in retirement, it's taxed in the hands of the spouse who will hopefully be in a lower tax bracket.
Ah, clever. Income splitting in retirement.
That's the goal. It can really lower the overall household tax bill when you're both retired. It's a powerful tool for couples with uneven incomes.
Definitely something to consider. What else?
The third main type is the group RRSP. This is set up through your employer.
Like a workplace plan.
Yep. Often, the big advantage here is employer matching. Your employer might contribute a certain amount for every dollar you put in.
Free money?
Essentially, yes. If your employer offers a match, you should almost always take advantage of it. It's an instant return on your investment.
Okay, let's shift gears and really dig into the mechanics of contributions. This is probably the most crucial part to understand correctly.
Right, the contribution room. How much you're allowed to put in each year. This is where that notice of assessment comes in handy, you said.
Absolutely critical. So here's the basic formula the CRA uses to calculate your new room each year. It's 18% of your earned income from the previous year.
18% of last year's earned income. Okay.
But auntie, and this is a big, but there's a maximum dollar amount set each year. It changes with inflation. For example, for the 2025 tax year, the maximum was $32,490. So it's 18% up to that yearly cap.
So even if 18% of my income is, say, $40,000, I only get $32,490 in new room for that year.
For 2025, yes. That's right. You hit the ceiling.
Okay. Now, what if I didn't use all my room last year?
Yeah.
Or the year before? Is it gone? No. And this is fantastic news. Any unused RRSP contribution room carries forward indefinitely.
Real, so it just stacks up.
Yep. If you had $10,000 of room last year, but only contributed $2,000, the leftover $8,000 gets added to whatever new room you generate this year. You could potentially have a huge amount of accumulated room if you haven't contributed much in the past.
That's huge. Okay, back to earned income. You said it's specific. What counts, and maybe more importantly, what doesn't count?
Right. This trips people up. Earned income for RRSP purposes mainly includes your salary or wages from a job, net income if you're self-employed, and net rental income from property you own.
Okay, employment, self-employment, rental income. Got it. What's out?
This is key. Earned income does not include things like investment income, dividends, interest, capital gains from non-registered accounts.
So my investment portfolio growing doesn't give me more RSP room.
Correct. Also excluded are things like pension payments, like CPP or OAS, retiring allowances, and most government benefits. Also, things like inheritance or gifts don't count.
Right. It has to be income you earned through work or business, basically.
Pretty much, yeah. Now, there's another major factor that can reduce your new RRSP room, and it catches a lot of people off guard.
What's that?
It's called the pension adjustment, or PA.
pension adjustment.
Yeah.
Oh, okay. Sounds ominous.
Huh. It's not ominous, but you need to know about it. If you participate in a registered pension plan at work, either a defined benefit, DB, or defined contribution,
Yeah.
DC plan,
Yeah.
the value of the benefit you earned in that pension plan during the year gets reported to the CRA as a pension adjustment. And that PA amount directly reduces the amount of new RRSP room you get for the following year.
Whoa, okay. Why?
The government's logic is this. Your workplace pension is already a form of tax-sheltered retirement savings. They see the PA as representing the room used up by your pension. So they subtract it from your potential RRSP room to prevent you from essentially double-dipping on the maximum allowable tax-sheltered savings.
Okay, makes sense. So say my 18% calculation gives me $15,000 in potential room, but my PA for my work pension is $7,000.
Then your actual new RRSP contribution room for the year would be roughly $8,000. $15,000 minus $7,000. The PA amount is usually found on your T4 slip from your employer.
So you absolutely cannot just rely on the 18% calculation if you have a workplace pension.
Absolutely not. You must know your PA, which brings us back to
The notice of assessment.
bingo.
Hmm.
Or logging into your CRA My Account online. That's where you find the definitive number, your RRSP deduction limit. That number already accounts for your earned income, the yearly maximum, and your pension adjustment, plus any carry-forward room. It's the one number you can trust.
Got it. That number is gold. Okay, let's talk about the payoff the tax deduction. How exactly does that work to save me money now?
It's beautifully simple, actually. When you contribute to your RRSP, you get to deduct that contribution amount directly from your total income when you file your taxes.
So if I earn $60,000 and contribute $5,000, I only pay taxes if I earn $55,000.
Essentially, yes. That $5,000 contribution reduces your taxable income by $5,000.
And the refund, how much do I actually get back?
The refund you get back is based on your marginal tax rate. That's the rate of tax you pay on your highest dollars earned.
Right, Canada has tiered tax brackets.
Exactly. So if that $5,000 contribution comes off income that would have been taxed at, say, 30%, then your tax bill is reduced by 30% of $5,000, which is $1,500. That $1,500 comes back to you as part of your tax refund.
Nice. A $1,500 refund for saving $5,000, that's a pretty good immediate return.
It really is. Especially if you then take that refund and reinvest it.
Good point. Now, deadlines. When do I need to contribute by to get that deduction for a specific tax year?
The deadline is usually March 1st of the following year. So contributions made in the first 60 days of a calendar year, January 1st to March 1st, roughly can be claimed against either the current year's taxes or the previous year's taxes.
So I have until March 1st, 2026 to contribute for the 2025 tax year.
Correct. That 60-day window gives people a chance after the calendar year ends to figure out their finances and make a contribution for the year that just closed.
Okay, this leads to an interesting strategy question. What if I contribute this year, but I know I'm getting a big raise next year, putting me in a much higher tax bracket? Should I wait to claim the deduction?
Yes. This is a fantastic feature. You can make a contribution now, get your money growing tax-deferred, which is always good, but choose not to claim the deduction on this year's tax return.
You can carry the deduction forward.
Absolutely. You can carry forward the deduction itself to use in a future year when you expect your income and therefore your marginal tax rate to be higher. Claiming the deduction when you're in a 40% bracket saves you more tax than claiming it when you're in a 20% bracket.
Smart. So contribute early for growth, but potentially delay the deduction for maximum tax savings.
It's a great optimization strategy if your income fluctuates or is expected to rise significantly.
Okay, one more crucial thing in this section, the danger zone. Over-contributing. What happens if I mess up and put in too much?
Yeah, this is the big one to avoid. The CRA is strict. However, they do give you a tiny bit leeway. There's a $2,000 lifetime over-contribution buffer.
Lifetime, so just $2,000 total ever.
That's right. You can go over your official limit by up to $2,000 in total across your entire life without immediate penalty. It's like a small safety net for accidental miscalculations.
Okay, but what if I go over by more than $2,000? Say I put in $2,500 too much.
Yeah, then you're in penalty territory. Any amount over the $2,000 lifetime buffer is subject to a penalty tax of 1% per month.
1% per month on the excess amount.
Yes, that's 12% per year. It's a harsh penalty designed to strongly discourage people from deliberately over-contributing. You have to withdraw the excess amount quickly to stop the penalty clock.
Wow. Okay, message received. Find your exact limit on the CRA website or notice of assessment and do not go over by more than $2,000, ever.
That's the rule. Check your limit, track your contributions carefully.
All right, we've nailed down the rules for getting money in and the immediate tax benefits. Let's talk about the long game, growing that money inside the RRSP.
Yeah, this is where the real wealth creation happens. We touch on it, but the power of tax-deferred compounding is really something.
Explain it again, maybe with an example. Why is deferring the tax so powerful?
Okay, imagine you have $1,000 invested and it earns a 10% return, so $100. In a regular taxable account, if your tax rate on that income is 30%, you immediately lose $30 to tax. You only have $70 of the earnings left to reinvest.
Right.
So next year, you're starting with $1,070. Inside an RRSP, that same $100 earning, it's all yours to keep working for you. No taxes taken out that year.
So you reinvest the full $100.
Exactly. You start the next year with $1,100.
Yeah.
Now, that might seem small initially, but multiply that difference paying tax yearly versus deferring it over 20, 30, 40 years.
The gap must get huge.
Enormous. Your money grows on your actual earnings, not just the after-tax leftovers. And the earnings themselves start earning returns. It's like a snowball rolling downhill, getting bigger and faster, especially when taxes aren't constantly melting parts of it away. Starting early maximizes this effect dramatically.
Makes perfect sense. So once the money is in the RRSP, what can I actually invest it in? Am I stuck with safe, low-return stuff like GICs?
Not at all. This is a common misconception. The RRSP is just the account type, the tax shelter. Within that account, you can hold a really wide variety of investments. The CRA calls them qualified investments.
Like what?
Oh, lots of things. Cash, obviously, GICs, sure. But also government and corporate bonds, mutual funds, exchange-traded funds or ETFs.
DAO stocks.
Yep, individual stocks, as long as they're listed on designated stock exchanges, which includes major Canadian, U.S., and international markets. You can also hold things like real estate investment trusts or REITs.
So pretty much anything you could hold in a regular investment account.
Largely, yes. There are some restrictions on things like private company shares or certain complex derivatives, but for most people, the choices are vast.
And you mentioned the self-directed RRSP earlier. That's where I pick and choose everything myself.
That's right. Typically opened at an online brokerage, you are the portfolio manager. You decide exactly what to buy, when to sell it. Maximum flexibility, but also maximum responsibility.
Which brings us to a really important warning sign, right? The RRSP shelters from tax, but not from risk.
Crucial point. Absolutely crucial. The registered part refers only to the tax status with the government. It offers zero protection against investment losses.
So if I put my RRSP money into, say, a high-flying tech stock and that stock crashes, my RRSP value crashes too.
100%. The underlying investments carry market risk. If your stocks or mutual funds go down, the value of your RRSP goes down. The government doesn't guarantee your principal or your returns.
So just having an RRSP isn't enough. You need a proper investment strategy within the RRSP.
Exactly. Which leads us to asset allocation.
Mixing different types of investments to manage risk.
Precisely. It's about finding the right balance between growth-oriented assets like stocks or equity funds and stability-focused assets like bonds or GICs. That balance should change based primarily on your age and how close you are to needing the money your time horizon.
Okay, let's walk through that spectrum. What's a typical mix for someone young, say in their 20s or 30s, just starting out?
For a young investor with decades until retirement, the focus should be heavily on growth. They can afford to ride out market ups and downs. So we call this an aggressive allocation. Maybe something like 70% to 90% in equity stocks, equity funds, ETFs, and only 10% to 30% in fixed income like bonds or GICs.
Okay, mostly stocks for long-term growth. What about someone in mid-career, maybe their 40s or early 50s?
The balance starts to shift. They still need growth, but they also have a larger nest egg to protect now. So they might move towards a more balanced portfolio. Maybe 50% to 60% in equities, and increasing the fixed income portion to 30% or 40%. It's about blending continued growth with more capital preservation.
Makes sense. Less aggressive, more stable. And then someone nearing retirement, say in their 60s.
Now the priority really shifts towards protecting the capital and potentially generating income. This is the conservative phase. Equities might drop significantly, maybe down to 20% or 30%, while fixed income becomes the dominant part, maybe 60% to 70% or even more. The main goal is to reduce volatility and ensure the money is there when they need to start drawing it down soon.
So the mix isn't static, it evolves over your lifetime.
It absolutely should. Regularly reviewing and rebalancing your asset allocation is key to staying on track for your goals. Okay, we've covered saving and growing the money, but what about taking it out? Generally, you wait until retirement, but are there exceptions? And what happens when you hit that age 71 deadline?
Right. Let's start with the general rule. If I just decide I need the money early, say for an emergency, what are the consequences?
The main consequence is tax. Any money you withdraw from an RRSP is generally treated as taxable income in the year you take it out. It just gets added to all your other income for that year.
So it could bump me into a higher tax bracket.
It definitely could, depending on the amount withdrawn and your other income. Plus, there's an immediate hit even before you file your taxes.
What's that?
Withholding tax. The financial institution holding your RRSP is required by law to withhold a certain percentage of the withdrawal right off the top and send it to the government.
Like a prepayment of the tax.
Exactly. And the rates are tiered. For withdrawals up to $5,000, they withhold 10%. That's 5% if you're Quebec.
Okay.
If you withdraw between $5,001 and $15,000, the withholding tax jumps to 20%, 10% in Quebec.
Steep.
And if you take out more than $15,000 at once, they withhold a hefty 30%, 15% in Quebec.
Wow. So you might only see 70% of your money immediately. And you still might owe more tax later when you file.
Correct. The withholding tax is just an estimate. Your final tax bill depends on your total income and tax bracket for the year. Plus, and this is huge, you permanently lose that contribution room. You can never recontribute the amount you withdrew.
Ouch. Okay, so general withdrawals are pretty costly. But you mentioned exceptions, ways to get money out tax-free.
Yes, there are two major programs the government allows for specific purposes, where you can essentially borrow from your RRSP tax-free. The first one is very popular, the Home Buyers Plan, or HBP.
Right, using RRSP money for a down payment on a first home, how much can you take out?
The current limit allows an individual to withdraw up to $60,000 tax-free from their RRSP. If you're a couple and both qualify, you could potentially access up to $120,000 together.
$60,000 tax-free is significant. What's the catch? You have to pay it back, right?
Yes, absolutely. It's treated like an interest-free loan from yourself.
Yeah.
You have a maximum of 15 years to repay the withdrawn amount back into your RRSP.
How does the repayment work?
Repayments have to start in the second calendar year after you make the withdrawal. The FRA sets a minimum amount you need to repay each year, basically 1/15th of what you took out.
And if you miss a repayment?
If you don't make the minimum repayments in any given year, that amount gets added back to your taxable income for that year. So you end up paying tax on it anyway. You need to track those repayments carefully.
Okay. And who qualifies as a first-time home buyer? Is it strictly just your very first home ever?
Not necessarily. This is the neat detail.
Yeah.
You're considered a first-time buyer if basically you haven't owned a home or lived in a home owned by your spouse partner in the current year or the previous 4 calendar years.
Ah, so you can potentially requalify for the HBP later in life if your circumstances change, like after a divorce or if you haven't owned for a while.
Exactly. That 4-year look-back period means it's not strictly a once-in-a-lifetime thing for everyone.
Good to know. Now, even though it's tax-free upfront, what's the potential downside or long-term cost of using the HBP?
The biggest cost is opportunity cost. That $60,000 or whatever amount you withdraw is out of your RRSP, potentially for up to 15 years while you repay it. That's 15 years where that money is not growing tax-deferred in the market.
So you miss out on all that potential compound growth.
Right. Especially if you use it early in your career, the long-term impact on your final retirement nest egg could be quite significant. Tens of thousands of dollars potentially. It's a trade-off. Help with home ownership now versus a potentially smaller retirement fund later.
Definitely something to weigh carefully. What's the second exception program?
The Lifelong Learning Plan, or LLP. This one lets you borrow from your RRSP to finance full-time education or training for yourself or for your spouse or common law partner.
Okay, for school, how much can you take out under the LLP?
You can withdraw up to $10,000 per calendar year, up to a total maximum of $20,000 over a 4-year period.
And repayment, similar to the HBP.
Similar structure, yes. It's also tax-free upfront, and you generally have 10 years to repay the funds back into your RRSP. Repayments usually start after you finish your studies. One nice feature is that if you remain a full-time qualifying student, you can often delay the start of the repayment period.
Okay, HBP for a home, LLP for education. Those are the main tax-free withdrawal options. Now, fast forward to age 71. That deadline looms. What happens?
Right. By December 31st of the year you turn 71, your RRSP, as you know it, must cease to exist.
Yeah.
You have to choose one of 3 main options for the funds.
Option 1.
You could take the entire balance out as a lump sum withdrawal.
But you said earlier that's usually a bad idea.
Generally, yes, a terrible idea for most people, because the entire amount becomes taxable income in that 1 year. If you have a sizable RRSP, say several $100,000, taking it all at once could push you into the absolute highest tax bracket, and you could lose nearly half of it to tax. Highly discouraged.
Yikes. Okay, avoid the lump sum, option 2.
Option 2 is to use the RRSP funds to purchase an annuity from an insurance company. An annuity provides you with a guaranteed stream of income for a set period, often for the rest of your life.
So, predictable income, but maybe less flexibility.
That's often the trade-off, yes.
Right.
You exchange the lump sum for income security. The payments you receive from the annuity are taxable.
And option 3, you mentioned it earlier.
Option 3 is the most common choice. Convert your RRSP into a Registered Retirement Income Fund, or RRIF.
RRF, how does that work?
It's essentially a seamless transition. The investments just move from the RRSP wrapper to the RRIF wrapper, tax-free. You maintain control over how the funds are invested. The key difference is, starting the year after you open the RRIF, you are required by law to withdraw a minimum percentage of the account value each year.
A mandatory minimum withdrawal.
Yes, the percentage increases as you get older. These minimum withdrawals are taxable income, forming part of your retirement income stream. But it allows you to spread the tax liability out over many years instead of taking that huge hit all at once, like the lump sum option.
So the RIF is the standard way to turn RRSP savings into retirement income gradually.
For most people, yes. It offers continued tax-sheltered growth on the remaining balance and a structured way to draw income.
Okay, we've covered a ton of ground. Getting started, contributing, growing the money, taking it out. Now let's tie some threads together and get into more strategic thinking. Starting with the big one, RRSP versus TFSA. When do you pick which?
The perennial question. The tax-free savings account versus the RRSP. They're both great tools, but they work differently, especially regarding tax. The best choice for you really depends on your current income and what you expect your income to be in retirement.
It comes back to tax brackets, doesn't it?
Largely, yes. Remember the core benefits. RRSP gives you a tax deduction now, when you contribute, but withdrawals are taxed later. TFSA gives you no deduction now, but contributions grow tax-free, and withdrawals are always tax-free.
So the simple rule of thumb is,
Prioritize the RRSP if you are in a relatively high income tax bracket now, and you reasonably expect to be in a lower tax bracket when you withdraw the money in retirement. You get the bigger tax break up front when it saves you the most.
okay, high income now, lower income later equals RRSP first.
Generally, yeah. Or, if your main goal right now is simply to get the largest possible tax refund, the RRSP is the way to go because of that upfront deduction.
Makes sense. Conversely, when should you prioritize the TFSA?
Prioritize the TFSA if you are currently in a low-income tax bracket. Maybe you're a student just starting your career, or have lower earnings, and you expect your income and tax bracket to be significantly higher later in life or in retirement.
Why?
Because in that scenario, the tax deduction from an RRSP isn't worth as much to you now, since your tax rate is low. It's better to skip the small deduction, let the money grow tax-free in the TFSA, and then pull it out completely tax-free later when you would have been facing a much higher tax rate on withdrawals.
So low income now, higher income later, TFSA first.
That's the general guideline. Also, the TFSA is much more flexible if you think you might need the money for something other than retirement, or sooner. Since TFSA withdrawals are always tax-free and don't burn your contribution room you get it back the next year, it's better for shorter-term goals or emergency funds.
Right. That flexibility is key. Now, you hinted at something earlier about low-income retirees. How do RSPRIF withdrawals affect government benefits?
This is a really critical point, especially for people who anticipate having modest retirement income. Some key government benefits for seniors, like the Guaranteed Income Supplement, GIS, are income tested.
Meaning the more income you have, the less benefit you get.
Exactly. And here's the kicker. RRSP or RRIF withdrawals count as income for calculating these benefits. So taking money out of your RIF could significantly reduce or even completely eliminate your eligibility for GIS.
Wow. So your retirement savings could actually prevent you from getting needed government support.
It's a potential trap, yes. But guess what doesn't count as income when calculating GIS eligibility?
Let me guess. TFSA withdrawals.
Bingo. Because TFSA withdrawals are tax-free, they are invisible for income-tested benefits like GIS. This makes the TFSA arguably a far superior savings vehicle for anyone who expects to rely on GIS or other income-tested benefits in retirement. It's a huge strategic difference.
That's massive, something many people probably overlook. Okay, let's circle back to the spousal RRSP. You mentioned it's great for income splitting, but there's a catch, an attribution rule.
Yes, the dreaded spousal RRSP attribution rule. It's designed to stop people from using the spousal RRSP for a quick, short-term tax dodge rather than genuine retirement income splitting.
How does it work? What's the gotcha?
The rule says, If the higher income spouse contributes to the spousal RSP and the lower income spouse, the owner of the account, withdraws that money within a certain time frame, the withdrawn amount gets taxed back to the contributor, the higher earner, not the spouse.
Defeating the whole purpose of income splitting, what's the time frame?
The attribution rule applies if the withdrawal happens in the year the contribution was made or are in the following 2 calendar years.
It's basically a 3-year waiting period?
Effectively, yes. If you contribute in, say, 2025, the spouse needs to wait until at least January 1st, 2028 to withdraw those specific funds without having the income attributed back to you, the contributor. The money needs to season in the account for a couple of years.
Good to know. A potential pitfall avoided.
Oh.
Now, for people lucky enough to have very large RRSP SRIFs, is there an advanced strategy called the RRSP meltdown? What's that about?
Yeah, the meltdown is a strategy primarily for affluent retirees who anticipate being pushed into very high tax brackets or facing significant old age security OAS clawbacks later in retirement due to large mandatory RRAF withdrawals.
OAS clawback, that's when your income gets too high and the government takes back some or all of your OAS pension.
Exactly. So the meltdown strategy involves intentionally withdrawing funds from the RRSP or RIF earlier than necessary, often starting in their 60s. Usually before OAS and CPP kick in fully.
Why would they do that? Pay tax sooner.
Yes, but the idea is to pay the tax at a lower marginal rate now while their income is relatively lower rather than waiting until their 70s and 80s when the combination of RRS minimum, CPP, OAS, and other income might push them into the highest tax brackets and trigger that OAS clawback.
So they strategically melt down the RSPRF balance at a lower tax cost today to avoid much higher taxes and clawbacks tomorrow.
That's the essence of it. By reducing the RIF balance early, they also reduce the size of those future mandatory minimum withdrawals. It's about smoothing income and minimizing total lifetime taxes paid. It's complex and needs careful planning, but it can be effective for some high net worth individuals.
Fascinating. Definitely advanced planning. Okay, let's wrap this section with 2 crucial administrative points that can save beginners a lot of grief. First, moving an RRSP between banks or brokers.
Oh, this is a classic mistake. If you want to move your RRSP from institution A to institution B, you must do it via direct transfer.
What does that mean?
It means you fill out paperwork at institution B, the receiving institution, authorizing them to request the funds directly from institution A. The money moves straight from one RRSP account to the other without ever landing in your hands or your regular bank account.
What happens if you don't do a direct transfer? Like if you just withdraw the money yourself and plan to redeposit it?
Disaster. If you withdraw the funds yourself, it counts as a regular RRSP withdrawal. That means immediate withholding taxes taken off, the amount is added to your taxable income for the year, and perhaps worst of all, you permanently lose that contribution room. You can't just put it back in. Always, always use the official direct transfer process, usually a T2033 form.
Got it. Direct transfer only, and the final administrative must-do.
Naming a beneficiary on your RRSP account. This is vital for estate planning.
Why is it so important?
If you name your spouse or common law partner as a direct beneficiary, upon your death, the RRSP funds can typically be transferred, rolled over, directly into their own RRSP or RREF on a tax-deferred basis. No immediate tax in.
And if you don't name a beneficiary, or name someone other than a spouse like your kids or your estate,
Then generally, the fair market value of the entire RRSP is deemed to be withdrawn just before death and becomes taxable income on your final tax return. This can result in a massive tax bill for your estate, potentially wiping out a huge chunk of the savings before your heirs see a dime. Naming a spouse as beneficiary or a financially dependent child, grandchild in some specific cases, allows for that crucial tax deferral. It's a simple form that saves potentially enormous amounts of tax.
wow. Okay, we have journeyed from the absolute basics to some pretty advanced strategies. I think the big takeaway is clear. The RSP isn't just a line on your tax form. It's a serious, long-term tool for building wealth, but you need to handle it with care.
Absolutely. And care starts with taking action. So for everyone listening, especially those who started this deep dive feeling unsure, let's outline some concrete next steps.
Step 1, you need to know your limit.
Right. Find your room, don't guess. Log into your CRA My Account online or dig out your latest notice of assessment. Find that exact RRSP deduction limit. That's your starting point. Write it down.
Step 2, don't wait.
Contribute early. If you plan to contribute for the year, try to do it as early as possible. Don't wait until the deadline next February or March. Getting the money in sooner means it starts compounding tax deferred sooner. Time is your biggest ally.
Step 3, Use the bonus wisely.
Yeah. Reinvest the refund. When you get that tax refund from making your RSP contribution, don't just spend it. Think of it as bonus savings. The smartest move is to put that refund right back to work, maybe by adding it to next year's RSP contribution or putting it into your TFSA. Supercharge your savings.
And step 4, don't set it and forget it entirely.
Review and rebalance.
Yeah.
At least once a year, take a look at the investments inside your RRSP. How did they do? Is your mix of stocks and bonds, your asset allocation, still appropriate for your age and goals? Rebalance if needed to stay on track.
Those are solid, actionable steps.
Yeah. And look, if you've listened to all this and still feel a bit overwhelmed, or you want help with the specifics, choosing investments, doing that direct transfer, figuring out the RSP versus TFSA decision for your situation, getting professional advice is always a good idea.
And that brings us back to the resources mentioned earlier if you're looking for that kind of practical guidance or help implementing these ideas.
Right. Check out the website muneris.com. That's muneris.com. Or, if you prefer, the contact info provided was phone number 778-898-3202 and email mansour@muneris.com. Having resources like that can be key to turning this knowledge into actual results.
Muneris.com, 778-898-3202, mansour@muneris.com.
Got it. Okay, let's leave our listeners with a final thought, something to chew on. We talked about prioritizing the TFSA if you're in a low tax bracket now. Makes sense. But why might it still be strategically smart to open an RSP account anyway, even with just a small contribution, maybe $100, even if you plan to carry forward the tax deduction for years until your income is higher?
Open it now, contribute a little, but don't claim the deduction yet. Why?
Think about it. By opening the account and getting some money in there, what have you started immediately?
You started the clock on that tax-deferred growth. Even on a small amount, it's growing without tax drag from day one.
Exactly. You lock in the growth benefit right away, maximizing the time your money works for you, while preserving the tax deduction to use strategically in a future year when it will save you the most tax. It's about optimizing both levers growth and deduction over the long term.
That's a subtle but powerful move. True long-term thinking.
It's playing the full game. Thanks for joining us on this deep dive into the RRSP. Hopefully you're feeling more equipped to get started.
Go find that contribution room.